afternoon, everyone. Thank you for joining us on this exciting day. We're going to be discussing landlords and tax and how to be efficient. So the topic of today's webinar is the landlord's guide to tax efficiency. So we're going to cover quite a lot over the next 40 minutes. And in a moment, I'll introduce ourselves and talk through the agenda we have planned. So today's agenda, we're going to go through the intros in a minute. I'm going to then talk to you about the autumn statement and some updates that you may need to be aware of. Wasn't a huge amounts of updates, to be fair, but some of the more relevant ones I'll just cover over. In particular, the changes to making tax digital and what that may mean to landlords. We're then going to come on to a very relevant topic for those who are invested into property, and that is around company accounting, limited companies, owning limited company, what it means, what you should be aware of. I'll then finish off with some property tax compliance points, and then, of course, cover over some of the tax structuring and advisory options that may be available to you. So as a way of introduction, so today's webinar will be brought to you by Fusion Consulting, the Fusion Consulting Group. So I'll be discussing the tax elements, and my colleague, who is the managing partner of our accountancy division, Antoniou, he'll be covering over the company accounting section. You can see all our details on the screen. So if you do want to discuss anything a bit more personal, be it about your limited company, your accounting, or indeed your tax matters, then you can get in touch with myself or George throughout today's webinar. You'll also see some nice award-winning logos on the screen. So as you may or may not be aware, we are award-winning on our tax side. We've got a Tolley's Taxation Award, and this year we've been recognised by the Spears magazine as recommended accountants and tax advisors for high net worth individuals in the UK. And we specialise in writing taxation advice. Quite a few of you may have known about this webinar or known about me via my social media, Mitch the Taxman. So for those that haven't enjoyed that, please, you can go on to TikTok and Instagram and get some regular tax tips. So welcome to all of the new people today on the webinar from those sources, and of course some of our valued clients today. So I mentioned the Fusion Consulting Group just very briefly. The idea of what we're trying to achieve is by having all your key advisors in the same company, helping you save time and money. So we have the accountancy division, the tax advisory division, wealth management, and legal divisions, aside from a couple of others. But those core professional services, whether you're a business owner or a family, they all need to be communicating. They all need to be in sync in order for you to achieve optimum efficiencies. So if you do have siloed advisors, there could be frustrations there. Now could essentially be the time to have a chat with us. And of course, for everyone on today's webinar, we'll be offering a free consultation. You'll see that on the slides. We aim to be speaking for around about 40 minutes, give or take. So that will allow about 5 minutes for questions. So let's strap in and away we go. So the autumn statement obviously was held, and there was obviously a lot of media about tax cuts being made, of which there were minimal. One thing that we wanted to talk to everyone about today was the update towards making tax digital, and there were some changes. I guess one of the biggest changes, particularly affecting the property industry, was that any landlord that has gross receipts of £50,000 or more will have to register for Making Tax Digital, which will come in April 2026. So the key points around this is that previously Making Tax Digital was going to come in for all landlords when their income was over £10,000. So they've now extended that to a £50,000 gross rent receipts. So this is gross rents. Obviously, it's not, you can't deduct your sort of mortgage interest or management information from that. This is gross receipts, £50,000 or more. You'd need to register and start submitting quarterly tax submissions by April 2026. Some of the questions that I've had since the announcement have been, well, what if it's sort of joint property? If it's joint property, then it'd be on your share of the property, your gross share. So, you know, if it is 50,000, there's 25,000 gross rents to you and 25,000 to your partner. In that situation, you won't need to register for Making Tax Digital in the current format. We then have the period between 30,000 and 50,000. So between £30,000 of gross rents and £50,000, you'll need to register a year after in April 2027. They did caveat all of this by saying further guidance is to be produced. So, you know, let's wait and see. Obviously, there's going to be an election before April 2026 as well. So we'll wait and see. But nonetheless, it is likely that will come in. And currently, it's at the £50,000 mark in April 2026. What essentially that will mean is that there would need to be, rather than your usual self-assessment annual tax return, it will be on a quarterly basis. You'll need an accounting online system in order to submit that data quarterly. And the quarterly submissions are cumulative. So essentially that will be rolling every quarter in terms of the cumulative income which you're submitting to HMRC. They did remove, not that anyone particularly cares too much, but they did remove the end of period statement. So previously what they were saying is that you have to submit these quarterly tax submissions, and then at the end of the year, you've got to submit a summary statement, which essentially will be totaling all of it together, as well as the quarterly, which, you know, a lot of people in the industry, you know, fought against HMRC because they felt it was totally unnecessary, and now that's been removed. So those are really the key points to cover off from the Making Tax Digital side. Overall, you know, it's relatively good news. You know, I guess if you're receiving gross receipts of that level, it's most likely you're treated as running that as a business. So you should follow the same guidelines as most sorts of small businesses anyway. But for your smaller landlord, then you would just follow the usual self-assessment method as you have been already. So the autumn statement, just carrying on. So this section is going to be on business support. In my opinion, there wasn't enough support there for your SME type of business in the UK. Just a couple of points really on this to cover off. So the national living wage was increased from £10.42 to £11.44. And probably the biggest headline of the statement was around the national insurance cut. So he announced a 2% cut to the main rate of national insurance, which apparently is going to benefit 27 million people. And the interesting note, or one of the interesting notes on this, is that it's not going to come in at the start of the new tax year. It's going to come in as of the 6th of January 2024. So that's going to be an immediate change. And the reduction only applies to earnings between your personal allowance, £12,570 to £50,270, meaning that the maximum saving that an individual can make is £754 a year. an average worker in the UK earning 35,000 is essentially £450 over better off throughout the year. So yeah, you can make of that as you wish. Other points was around business rates, so freezing small business rates, some enhancement if you're essentially creating some AI within your business and support to that, and then I guess finally, if you're self-employed, there were changes to Class 4 national insurance being reduced by a percentage point, and Class 2 national insurance being abolished. So yeah, I had a slide on this pre-prepared, but essentially the taxes update from the autumn statement were essentially nothing. What I mean by that is that all sort of the changes that were put in place prior to this are going to continue. Capital gains tax, there's no changes to the capital gains tax rates. We knew already that the annual exemption from capital gains tax was being reduced on a year-by-year basis. So again, that's reduced now to 6,000, and then now the year after in April it's going to be reduced down again to the £3,000 mark. No changes to inheritance tax. It was highly publicised, and a lot of rumours around inheritance tax. No changes to inheritance tax. No changes to corporation tax. Again, people were predicting that would be reduced. There's no changes to that. The one change that there was to the research and development tax relief scheme. We have seen over recent years a big clampdown on companies getting their R&D reliefs approved with HMRC. It's a big area that HMRC are looking into. Genuinely, if you are creating something new and innovative, HMRC will support that, but it is harder to get through. They're now claiming changing the sort of the scheme, particularly in terms of how you account for losses within the scheme on that. But yeah, so those are the major sort of updates. You know, nothing too drastic. I think the big ones, as I mentioned, from our perspective, is to make changes to make it tax digital and national insurance. So I'm now going to pass you over to George. As I mentioned, as professionals, we are seeing a number of our clients either set up limited companies for the purpose of real estate investment, or incorporate their portfolios, or just inquire about limited companies. So I thought it'd be very useful for George just to basically give us an accounting 101 on sort of limited companies. So I'll hand over to George, who will conduct the next part of today's presentation.
Thanks, Mitch, and hello and welcome everyone. Thank you for joining the webinar today. As Mitch mentioned, obviously setting up a limited company for your rental purposes is something that comes from the tax advice that a good tax advisor should give, and that should be tailored to each and every person's individual needs. But having said that, if it comes out that you did need a limited company or wanted a limited company, we can run through some of the basics, and we might as well dive straight in. And the first thing you should be considering here is choosing a name. So yeah, you can have a bit of fun with that. Choose a suitable name for your company. Don't despair if you think of a name and it's already taken. There are certain elements and things that you could do to change that name, vary that name slightly to get what you want. And all you've got to do is just run that past Companies House, and that should be fine and okay. The second element is to appoint the directors. Now, obviously, the directors are the responsible individuals that will be running the business and making the decisions. And it's probably going to be yourself or your partner, whoever you may own the properties with. Thirdly, you will then issue your shares. So here you can choose different classes of shares. You can have the same shares where everyone has the same rights and same voting, same dividends, rights to dividends, or according to the tax advice that is given, you can create different share classes so you can have the availability to issue issue dividends to different individuals, or perhaps hold the shares in trust for children, for example, and it's basically can be tailored to whatever you need. A very important aspect of the incorporation is completing the register for persons of significant control. Obviously, over the years, things have been changing where it needs to be listed and written down and communicated who the ultimate controlling parties are. And this is an important aspect where people that own more than 25% of the shares, for example, are a person of significant control. Directors that have significant influence or control of the business, they should be registered as a PSC. If your shares are owned by a separate entity, another company, that becomes the PSC, and then you will then decide whether an individual in a holding company may have to be listed as well, because they will have significant control. So it's an important aspect that needs to be listed, and that is obviously held on the public record and anyone can see that. Registered office address is an important aspect here. You don't really want to register your personal address as the registered office. And importantly, you don't want to register your personal address when you put in the director's details on and the PSC details on. So really, you should be using an office address, or if you don't have an office, you should be using your accountant's address if they offer that service. And that way your personal address and details are protected from the public record. When creating a company, two important aspects are the memorandum and articles of association. So when registering online, the memorandum of association will be created automatically upon registering. So you don't have to worry about doing anything more formal than that. And if you are a standard basic company, you can use the standard articles. However, if you are going to create all the different share classes and different structures involved, you may want to have some tailored articles drawn up, and you should get some legal help with that. And luckily enough, we here at Fusion Legal have a great solicitor that helps in creating those articles. Moving on, once the company has been set up, there are some responsibilities that you will have to adhere to. First and foremost, you need to keep statutory records, and that can be in the form of the old-fashioned books that you used to get and used to fill in things like the share register, the director's register, and all sorts of the PSC register, which has been going for a few years now, and anything else that is needed for the statutory information. Secondly, you need to keep your books and records, and we'll touch upon that in the next slide, but it's important that you keep your receipts, your statements, your bank statements, anything that you need when recording your transactions of the business or the rental business, and it's kept for 6 years. If there are any changes that need to be made, for example, you want to change a director or add a director, you usually have to report these within 14 days to Companies House. There are other elements of changes that you have another 14-day grace period. So, for example, amending the PSC register or adding another person of significant control, as long as you update your register within 14 days, you then have another 14 days to update Companies House. But it's just safer just to go down the route of updating all information within the 14-day period. Then we come on to filing. There is something called the confirmation statement, which is a document that needs to be filed every year with a £13 fee. That document will hold basic information about the company, things like the directors, the registered office, the shareholders, and the person of significant control, and that gets updated each year. It's something that an individual can do themselves, but also you could ask your accountant to file that for you. Then the important part, which is preparing the accounts. You need to prepare your accounts over a 12-month period, usually. Obviously, the first year has some slight nuances because you may be slightly over 365 days, and there's just the rules slightly differ for that. But usually you prepare your accounts, or your accountant prepares your accounts, and they need to get filed accordingly. Once those accounts are drawn up and you know what your profit is or your loss, you prepare a corporation tax return, and that gets filed annually. And then most importantly for HMRC, any tax on profits needs to be paid on an annual basis. So just diving into these responsibilities in a little bit more detail, I just mentioned that you need to keep your business records. You can still keep paper records, but it's more and more the norm now to keep digital records, as long as you've got good, clear scans of the various records and information that is acceptable by HMRC. And you need to keep those for 6 years after the year end of the company. So please don't destroy your records in the next 2 years or something like that. Preparation of annual accounts and then the filing elements. You don't need to file your full accounts to Companies House, and you shouldn't file your full accounts to Companies House because you don't want your competitors or anyone else that's snooping to see your profit and loss account and the performance of the business over the years. So we are allowed to file something called a filleted version, or what used to be called the abbreviated version back in the day. This will be kept on the public record, and anyone can go into Companies House and search that and look at the basic information, which is basically the balance sheet and any notes to the accounts. You need to file the accounts to Companies House within 9 months after the year end. A full version of the accounts has to be filed to HMRC along with the corporation tax return. Only HMRC will have sight of this full accounts, so don't worry about anyone else snooping around and seeing the performance of your business. And you need to file your tax return, strangely, 12 months after the year end. There's always been a rumor that they were going to align this deadline with the Companies House deadline of 9 months, but we're still to see, or we're waiting to see if that ever does happen. Please bear in mind, though, when preparing the corporation tax return and the accounts, you need to have various software to prepare this and attach something called IXBRL versions of the accounts, which are digital versions of the accounts, to the tax returns, so they can be filed accordingly to the HMRC rules and regulations. Penalties for late filing are quite important here. We need to keep an eye on the deadlines. You all need to keep an eye on your deadlines, because penalties are on a increasing basis. So if you are late by 1 month, it's around £100, and if you're late again a little bit later on, 2-3 months down the line, there's another £100 penalty for the corporation tax basis. But the Companies House penalties are a little bit more heavy. It's £150 at the moment if you're late. If you're late after another month, it rises to £375. If you're late after 3 months, then it's £750, and then after 6 months, it's a £1,500 penalty. So please ensure that your accounts are prepared and filed on time. But also be aware, if you're late twice, i.e. the second year you are late in filing, any penalty levied does get doubled. So those penalties do rack up if you're late. Please take it very, very seriously. Moving on to the corporation tax filing. Like I said, you have to prepare a tax computation and the tax return. You've got to file that 12 months after the year end. And the strange thing here is you need to pay your corporation tax 9 months and 1 day after the year end, not on the 12th month where you need to file the tax return. You actually need to pay your tax before then. So it's a weird one. You need to make sure that your corporation tax computation and tax return is pretty much prepared, pay the tax, and then you can file the tax return. But there you go. Again, I've mentioned the penalties for late filing. A late tax return is £100, and then a few months later, another £100 get added. There's a little pitfall here. On the first year of trading, or the first period, most businesses have more than 365-day period, which means there are 2 tax returns that need to be filed in that first period. And if you are late, then you're going to get 2 lots of penalties. So please, again, make sure that your accounts and tax returns are filed on time. And on top of penalties for late filing, there is also interest for late payment of tax. So again, please try and pay your taxes on time. I think that's it on my slides. I will hand it back over to Mitch. And if you've got any questions about what I have just discussed, again, these are the basics. If you want to have a chat, please get in contact with us and we can discuss any strategy for you going forward. Thank you.
Yeah, thanks, George. Really useful. A lot of people just, set up their limited companies without actually knowing, the full mechanics of what it actually entails. So that's hopefully it gives everyone a good insight. I'm just going to carry on the theme of compliance. When you own a property, whether that's via a company or individuals, you need to be submitting a self-assessment tax return. The self-assessment tax returns for the tax year April to April. We've got the filing period coming up, 31st of January 2024. That is for the tax year ending April 2023. So essentially, the tax year always works a year behind. So for those who are listening that need to file tax returns or have rented out property for the tax year ending April 2023, will need to ensure that they submit their self-assessment by the 31st of January online 2024, otherwise receive penalties. And, it's fair to say that HMRC have a tremendous amount of data now at their fingertips. They've got a new CRM over the last few years, and that's feeding in data from the likes of Land Registry. They issue what's called one-to-many letters. So they get data, and then if it doesn't match up on someone's return, they just spit out these one-to-many letters. On the property side, it's something along the lines of, we've become aware that you may own this property, and they list out the property. Can you confirm if this is correct? And then they start asking questions whether it's actually been rented out. So it's much better to, of course, comply all the time, because ultimately HMRC will be in touch. So that's very important. Just wanted to touch upon sort of capital revenue expenditure. When you own the properties individually, there's a distinct difference between what you can claim on a yearly basis and then what you can claim when you deduct the tax when you sell the property. And this is sort of classified as revenue and capital expenditure. And it's important that you do things correctly so that you don't double account for it, but also what you can and can't do from an HMRC perspective. So revenue expenditure is your day-to-day business expenditure that you're incurring for the running of the business, in this case, a property. So that may be your basic repairs and maintenance, your management charges, obviously an element of the mortgage interest. We know there's a different sort of tax deduction for that, your annual insurances and things like that. That can all be deducted against rental income in that year. and then you'll pay tax on the profits. Capital expenditure is items such as if you're renovating the property, you're putting in a new kitchen or bathroom that's going to significantly add value to the property. If you're doing building work, so an extension that's going to add value to the property, all those costs, associated costs with is classified as capital, and you can't claim those costs in the year against the rental income. You keep those in your file ready for when you sell the property. You can deduct those capital costs, and then that obviously helps from a reduction from a capital gains perspective. So it's important that you understand what you can and can't claim. It's important from a compliance perspective that that you are compliant. Obviously, we've touched upon the powers of HMRC. The other thing to note with property now, if you are selling property, essentially you need to submit a capital gains tax return within a 2-month period from the date of the sale as well. So previously you would just note the sale on your self-assessment. Now you need to submit an additional capital gains tax return as well. So there's a lot of compliance involved around property and business in general. So it's important you have a good team in place assisting you all the way through, because penalties are high at the moment. Now, I guess the good news is if you haven't complied, there is currently an HMRC voluntary disclosure. For anyone that's rented out property but may not have realised that they needed to submit a tax return for a variety of reasons, we can register you to take part in the voluntary disclosure. And then once we've registered via our agent portal, you have 90 days from the date of the registration to bring your tax affairs up to date. Now, the benefit of doing this is that once you're registered, HMRC cannot open up an investigation. And also the late filing penalties, so the statutory penalties for late submission, automatic penalty £100, but throughout the year, it can equate to sort of £1,200 or more. All those late filing penalties don't apply. And then also the penalties for late payment of tax get capped at 10 or 20%. Whereas at the moment, if HMRC were to investigate, they could charge penalties all the way up to 110% at the extreme level. And then, of course, you get complete peace of mind. So it's certainly worth embarking in this exercise if you haven't been submitting tax returns. So essentially you have 90 days, complete all the tax returns, complete the disclosure document, work out the tax interest penalties that you're due, pay that over, and then HMRC respond usually within a 4-week period and essentially, write back saying, right, you've now complied with everything. Please ensure that you comply moving forward as well. So that's a great disclosure. You never quite know how long these disclosures are going to be available. HMRC can cut them at any point. So please do take advantage of that and get in touch if you need any assistance. So the final part of today, I'll talk for about 10 minutes longer before we'll be on hand to answer questions. It's just understanding what sort of structuring options may be available to you. Of course, particularly property as an asset class affects a number of different taxes. If you are sitting there owning properties in your personal names or joint names, and you do have other sources of income, which means you're at the higher rate of tax, then one should consider what options they have available, because as we know, you can't fully claim the mortgage interest against the rental income from a tax perspective. This creates artificial profits of which you're subject to tax. So it's making it very inefficient from a tax perspective to hold properties in your own name that are mortgaged when you are in a higher rate of tax. So we need to look at the options and solutions And aside from this, of course, we've got inheritance tax. So more often than not now, families in particular are wanting to protect their assets. They want to protect their assets from the family bloodline perspective, and of course have one eye on the longer term tax, which of course is inheritance tax. So this is becoming very prominent in a family's thinking, and coupled with the fact that you've got this Section 24 is having a lot of clients wanting to review their exposure. And there's no magic wand. A lot of people can be more tax efficient, but ultimately, particularly with property and real estate, it's about looking at the interaction between every single tax. So we could create a structure which may involve the trust, it may involve the limited company, it may have, longer term tax benefits, but what's going to be the shorter term tax impact? So a lot of sophisticated modeling, hypothetical type of analysis needs to be done in order to get to a solution that you indeed understand the pros, the cons, the legalities, and of course your advisor is comfortable in. So some of the things that we're looking at the moment or have been are essentially clients, Mr. and Mrs. Jones, have their property portfolio, whether that's 5 properties, 12 properties, 50 properties. They own it together as individuals. How can they move that into a limited company? Or can they move that into a limited company? Why should they move it into a limited company? Ultimately, the theme today has been a bit about limited companies, but ultimately why one might consider moving their property portfolios into a limited company is because you'll be able to benefit from sheltering the income at the corporation tax rates level, which is better than income tax. But also, once the properties are in the name of the limited company and the mortgages could be put in the name of the limited company, then you're able to deduct the full amount of interest against the rental income within the company. So you're paying true tax on profits at corporation tax rates. So that is better. But then, of course, depending on the client situation, it's about, right, what if we need to extract money from the company? Then what? Yeah, and of course, there's income tax on the dividends, and it's about modeling that out. A lot of what we do is around sheltering monies within a limited company. You may have your property company, trading company, and then we might create a family holding company that owns everything, and potentially with a trust. So you're getting the best of both worlds, utilizing monies within the structure. Ultimately, of course, as you're speaking, you can begin to understand the complexities across different solutions like this. And what I'm going to come on to as well is that it's not just a tax decision making here. There's lots of other factors in terms of finance that needs to be considered. So just broadly, I know we don't have a huge amount of time, but broadly, okay, when you have a portfolio business, so in this instance, we're saying that you've got X number of properties is your main source of income. You're spending more than 25 hours a week in running that business. Then when you move it from your name to a limited company, potentially you can claim something called incorporation relief from a capital gains tax perspective, because ultimately you own those you own those properties. If you gift them to someone else or you sell them to someone else, then normally there's a capital gains tax bill. What potentially one could argue is that you're running your portfolio as a business, and therefore when you incorporate it into a limited company, we can claim capital gains tax relief. And, these are the conditions. We can go through it in another webinar. Ultimately, what we found out over recent times as well is that there will be some case law coming out. Some other sort of third parties are being looked at in terms of this type of planning. The key thing is that you have to be very strong that it is a business. And also, when you're moving everything into a limited company, it's a whole or nothing relief, right? So what that means is that, let's say you've got a portfolio of 10 properties, but you actually really like one of the properties in Dorset or wherever, and you want to keep that, and you don't want it in the company. In order to claim incorporation relief, you have to move all your properties that you own into the limited company in order to claim incorporation relief, the rental properties, that is. Furthermore, you've got this whole issue with the lending. So, of course, one of the biggest issues in terms of this, not from a tax perspective, but from, I guess, a legal perspective, is that the lending should move when you incorporate. So ultimately, it's advisable to move the lending into the name of the limited companies. And of course, you'd need to speak with your broker, your lenders, to understand the impact. Is there an exit charge? What does that mean? Can you waive the exit charge? Do you have to wait, a year or so? Are there interim solutions, etc., etc.? Some people have looked at trust work with the lending at that point, but ultimately, I think what we'll find over the years is that case law will show that it might not meet the conditions of incorporation relief if you have just a sort of bare trust owning the debt. The other areas we look at is around partnerships. So, you may own the properties with your civil partner or spouse. And then ultimately, it's about, can we create a formal partnership? Why would you want to create a formal partnership? Well, at the moment, there is something in the legislation whereby if you incorporate a formal partnership, you can potentially mitigate stamp duty land tax. So the idea is that you're trading as a partnership for a minimum of 3 complete tax years, and then for commercial reasons, you may decide to incorporate. So it gives you good options in the future, a partnership whereby even if you own it jointly, it may be worth just formalizing the arrangement so that you'll have options in the future in regards to stamp duty, land tax mitigation. Of course, rules may change. It all has to be done for commercial reasons, but this is something that potentially can be looked at as well. Stamp duty is one of those really tough taxes that is very difficult from a planning perspective. It is what it is, but ultimately the use of partnerships in the right way, in the right time, not for artificial reasons. There is HMRC anti-avoidance around the use of partnerships, in the sense of you can't just create a partnership day 1, incorporate day 2. There's loads of anti-avoidance around that. So you have to run the partnership for a minimum of a 3-year period. Ultimately, what we may look at, depending on your net worth, depending on the number of properties, depending on your children, etc., is a family investment company. So, of course, we look at trust work for bloodline protection, but ultimately the use of a family investment company, which is essentially a limited company governed by a shareholders agreement, governed by different classes of shares. I think George mentioned that a bit earlier, which will have different rights. And ultimately, we're using a corporate structure for the future benefit of the family. Now, that may be in the initial holding company, which owns the other assets. More recently, we're setting up family investment companies with some of the shares being held into a trust as well, but ultimately that will give you good options. If you do have available cash reserves, so quite a lot of our entrepreneurs are going through a sale of their business, so they have a capital event. If you can initially fund the family investment company via the use of a loan, then what happens is that you're growing your assets and your investments, and then you just repopulate your income via the use of the director's loan. And that's a very tax efficient way of working. Family investment companies are 100% HMRC approved. When they were first set up many years ago, HMRC did appoint a whole unit to look into them, but that got closed 2 years ago now, as these are compliance structures. And finally, just to touch on the ATED. So we spoke about limited companies today as a bit of a theme. The ATED stands for the Annual Tax on Envelope Dwellings. And essentially what it means is that if you own residential property, which is valued above £500,000, which is owned by a limited company, then you'd have an additional tax compliance procedure to follow. So every April, so 30th of April, you will need to submit what's called an ATED tax return. And then depending on your circumstances, there may or may not be tax to pay. This is essentially to stop, or was brought in to stop, foreign owners purchasing London real estate via corporate entities, and they would just use them just to hold them for the future benefit of themselves or their family. So essentially, if you just buy the property via a limited company and you use it for yourself or your family members or connected parties, then there'd be an annual tax charge every year depending on the value of the property. So for instance, 500k to £1 million, the tax charge is £3,725, and it goes up in tiers accordingly. If, like the majority of cases, you've purchased it for third-party investment purposes, so you're renting it out on market value terms to third parties, then there will never be a tax charge, an ATED tax charge, that is. But you still have a requirement to complete an ATED tax return and claim the relief on the ATED itself. So there is a filing requirement. Not that many people actually know about it when you are purchasing real estate, residential property via a limited company. Something to bear in mind. If this does apply to you or did apply to you and you need to tidy up, contact us and we'll help you tidy up. Ultimately, I believe the time is now to consider structure and your options. We're one of the only companies in the UK who essentially model out structuring advice. So we will go through your current exposure, go through what you can and can't do, go through what you're planning in the future, and model it all out from a tax and financial perspective, and then ultimately gear towards the master plan, which we can, of course, be on plan to implement, or can give it to your existing advisory team to work towards. It's an interesting time now. Capital gains tax rates are still what they are. Reliefs are still what they are and available. We are going to see an election over the next year, most likely. Particularly, we haven't covered it in today's webinar, but certainly in a new year, I will be doing a webinar on, what the election could mean, and particular for those who are non-domiciled. So non-domiciled will mean you weren't essentially born in the UK. Then now's the time to look at what you can and can't do, really, because those rules are going to be ripped up if Labour come in. So we're reaching the end of the calendar year. We're coming up to the end of the tax year in the end of March. So really, it's a very good time, this winter months to look at your structuring today. So hopefully you've got some good nuggets of information from us, and you haven't fallen asleep. If you have, wake up. It's question time. So George and I will stay on for the next sort of 5 minutes or so. Feel free to ask us any questions you may have. Also, as mentioned, we know with tax, accounting, financial planning, it's highly personal. So you've got our email addresses on the screen as well. So please feel free to email. We always offer everyone an initial consultation where the team will be on hand just to chat about your circumstance, answer some initial questions, and then we can follow up if we can potentially be of assistance. Okay, so I'm just gonna read off some comments. So Palvi said, how do you move the properties from individual name to limited company in the most tax efficient way? So yeah, I think obviously we covered that. I covered that briefly, the options around that. Essentially you need to crunch the numbers individually to work out A, whether you can claim relief, B, if you can't, what is the best option in terms of structuring and moving the properties in. It's not a guarantee that you can move them in both legally and from a tax perspective. So you need to work out and get the advice about what you can do, and then go from there. Why would you want? So a question from Derek, why would you want to transfer buy-to-let properties into a company, potentially have CGT finance costs, early repayment fees, etc.? Yeah, exactly. I mean, this is the point. This is the key point, is that no one really knows the key tax and financial benefits, short, medium and long term, until they actually crunch the numbers. And it's about whether you can crunch those numbers yourself and make a financial decision on them, or you need the support of your advisors. Because it's so complex, I would say that, if you are in an inefficient state of an income tax perspective, it's worthwhile doing that exercise. So we've got another question here from Raj. What's the best way to release cash while moving properties from the partnership to the limited company through the mortgage deed? What's the best way to release cash moving the properties? Well, I mean, essentially, when in terms of a cash perspective, when you own them within a partnership, essentially you're taxed on the income position regardless, and then you can utilize the cash accordingly. So before it goes into the limited company, you're going to have this net position, and depending on what your partnership deed says, but essentially you would have paid tax on that income. You can utilize the cash accordingly. Obviously, once it's in the limited company, depending on how that's been put in, etc., in order to get the cash out, you may have to pay the tax on it. In terms of the mortgage deed itself, again, I would be careful in the sense of speaking with your mortgage company and providers and making sure that that can be put in the name of the limited company accordingly.
Mitch, Derek sent a second question about doesn't HMRC regard property as an investment rather than a trade or a business? As such, wouldn't this debar incorporation relief? Well, Mitch did touch on that a little bit earlier, in the sense that there is case law out there that, depending on an amount of properties and how much time is spent administering these properties, they may be classed as a business. So this is what needs to be explored and investigated in your own portfolio, which will give the tax advisors the opportunity to advise accordingly.
Yeah, I think that's right. There has been some case law, with the main one being how many hours in which you're spending on managing the property itself throughout the week. But it's not just that one silo element you need to look at. You need to look at the badges of trade and so on and so forth. So you're right in the sense of, if you own a couple of investment properties or rental properties, and you've got an employed job, and you've got a managing agent that's looking after the properties, it's going to be highly unlikely that if you were to move those properties into the name of a limited company, that would qualify for incorporation relief. All right, George, you want to pick up the question from James?
Let me just go find it. Is it in chat? What is the optimal way to liquidate a property rental company? Well, we're not liquidators, unfortunately, but you would need to get professional liquidators in position. We do have various liquidators that we use and we could introduce, but I'm not so sure why you would want to liquidate a property rental company. The whole point is that these properties are there for future generating of income, and I imagine for future of one's family. So not sure what you're asking, unless the mortgages have gone sky high here and they are more than what the properties are worth, perhaps.
Okay, all right. Well, yeah. Thanks, everyone. Thanks, George, for your wisdom as well. We'll be back. There's going to be a webinar from Fusion just before Christmas on financial advice. So look out for that one. Look out for our marketing. Of course, if you'd like to get in touch with us to discuss your matters and structuring, please do reach out and get in touch. It'd be a pleasure to support you. Appreciate everyone's time and George's time. And yeah, I look forward to seeing you on another tax webinar in the new year. So I wish you Merry Christmas if I don't speak to any of you before then, and have a great day.